Good evening and welcome to another episode of my weekly webinar. My name is Daniel Ang, and of course, today is March 23rd, 2025. And as far as the week is concerned, we are now into week number 12 of 2025. And it also marked the 63rd day of Trump 2.0. So that means Donald Trump has been in office for more than 2 months now. But despite the short time that he has been in running the Americas, we can see that his policy impact has been outsized. We all know the market has been reacting in very violent way. And today, the topic of this presentation is Fed, inflation, and market expectation. So it will be a little bit different from my regular weekly market rep. Now, in this version, I'm going to do something different. Instead of feeding you with a lot of data sets for the week in terms of economic data that's been released, not only for the United States, for China, for Eurozones, for Canada, for Australia. I'm just going to concentrate on America. After all, America is the world's largest financial markets. And I will also do a little bit different in terms of my market outlook. Instead of me telling you what I want to show you, I will give you the chance to actually tell me what you want me to show you in terms of equity market index, in terms of currency pairs, as well as commodities and cryptocurrencies. So you tell me what you want to listen to, and I will go ahead and give you my views. Okay. Now, before we go into the content proper, just be aware that this presentation is no means a offer to buy or sell any kind of securities, be it FX, CFDs, or even crypto. And this is definitely not an investment advice. And just be aware that trading of any kind of margin products do carry risk of loss. So be very well aware of your financial position before you attempt to trade any kind of leverage financial products. And I'll be sharing with you my views of some of the markets that you pick. And those are just my views. They are, again, by no means investment advice. And the content of this presentation obviously has not been vetted by any regulatory body. So just be aware of these limitations. And of course, I would like to also acknowledge the sponsor of this webinar, IronFX, who has been sponsoring my event for quite some time since last year. This IronFX has operation in more than 180 countries with hundreds of investment products on their MT4, MT5 platform. So you can actually choose any of those, including not only FX and of course equity index and commodities, and of course cryptocurrencies. So just be aware there are a wide range of products available on your platform for trading. Again, you want to make sure you understand what you are getting into before you put in real money. Okay. So I'm going to start off with talking about the US inflation. Now, in this particular chart here, I'm showing you a 5 years rendition of the US inflation situation. We knew at the start of, shortly after the start of the war in Ukraine between Russia and Ukraine, we knew that inflation has been rising, and it has been rising very, very steadily until it hit a peak somewhere in the middle of 2022. So we can see that that curve up, in terms of the CPI. Now we are only showing you the core CPI, meaning to say that I'm taking away the components of food and energy, because these two are actually quite volatile, and it's very common for decision makers, for example, the Federal Reserve, to look at the inflation by taking out these two very volatile sectors, which is food and energy. So we can see these core CPI numbers, and we are looking at a year-over-year data set here. So we can see the inflation actually peaks somewhere in the middle of 2022, and it has been gradually be coming down. Now, the last number that we knew was February 2025. The core CPI index is currently at 3.51. And definitely we can see that it is almost half of what it used to be. So in this instance, we can safely say that inflation based on this CPI data has actually eased back. But the market has been beset with talks about inflation's been very, very stubborn. So despite the evidence here that the CPI has actually been coming down, we need to say that inflation in the States has been gradually been easing. Consumers on the floor, as far as their daily expenses is concerned, they still complain about some prices being very stubbornly high. Now, example of which is the price of eggs in the United States. There was a strain of the avian flu in the States, and that resulted in the calling of a lot of live chicken, and that has led now to a situation in which fresh eggs are in short supply. Okay, and that has also been seen in the food prices. That's why we take away the food and energy component when measuring the inflation. And if we do add food and energy into the CPI calculation, we will notice that inflation is definitely a lot higher than the number 3.1 3.51 suggests. So by and large, you can see that the talk of inflation, despite the official data showing us it has come down quite significantly from the peak 2 years ago, we still have the conversation in which inflation is still deemed to be very, very stubborn. So that leads to the next situation in which the US Central Bank, which is the US Federal Reserve, they would have to deal with how to respond to inflation or talks of inflation. Now, the fact that last year, in the last quarter of 2024, the Federal Reserve has actually reversed their monetary policy from keeping interest rate elevated at the highest point in the Fed fund rate, which is the interest rate charged by the central banks for all commercial banks in the States, is at 5.5%. And in the last quarter of 2024, the Federal Reserve, which is the central bank of the United States, has gradually been cutting interest rates down to the present 4.5%, or what we call 100 basis point. So market going into 2025 has a lot of expectation. Market participants are actually thinking that the Federal Reserve may continue to cut rates going into 2025. And talks of further interest rate cut is still quite alive in the marketplace, especially after last week when the Federal Reserve indicates that they are looking at the inflation story very, very closely, because in November of last year, remember, Donald Trump unexpectedly won the US presidential election, and that threw a lot of calculation into disarray. And we all knew Donald Trump has been talking about how he is going to use tariff as his main policy tool to achieve a few things. Now, Donald Trump has two problems at hand. One is the runaway US national debt, which currently stands above $36 trillion and looks like it is going to be increasing. Okay, and to deal with that, he definitely would have to narrow the US trade balance with its trading partners. Now, US does export a lot of services, but as far as goods are concerned, the US imports more than they export. So the United States has a deficit in terms of trading in goods. And Donald Trump has always blamed other trading partners for unfair trading practices in which they maintain very high trade surplus relative to the United States. So Trump, in his own mind, believed that he can tackle this by imposing punitive tariff on all goods coming into America. Okay, and he has actually started doing that, and the market is not taking his policy very, very well. Now, initially, the market was expecting that Donald Trump is just going to posture, he's going to use the threat of imposing very punitive tariff on his trading partner, basically as a negotiation tool. And he has used that already he has proved that he is using the tariff as a negotiation tool, because the reason for him to impose 25% tariff on Canada and Mexico has been nothing to do with economics. He has been blaming both countries for flooding the United States with fentanyl, which is actually opioid. And he believed that by imposing punitive tariff on both Canada and Mexico, he can stop the flow of this fentanyl into America. Now, the other problem that Trump has is that he believes the border has not been guarded, and that resulted in unrestricted pouring of immigrants into the United States. And Trump has also campaigned during his campaign trial that he's going to deport, or rather mass deport, illegal aliens back to their countries. Okay, and he used high tariff as the excuse, hoping that the country would take back all their citizens. And that, to a certain extent, has been ongoing, although it was not in the scale that he was suggesting during his campaign leading to the November 2024 presidential election. So again, Trump has one big problem, which is the national debt, in which he's trying to deal with this using tariff. Okay, now the other problem that Trump is trying to resolve is definitely the dollar. Okay, he believes the dollar is too strong and he wants a weaker US dollars. Not so much as anything, but he wants to make the dollar competitive relative to the other major trading currencies. And he also definitely, to get a lower dollar, he needs the Federal Reserve to start to continue rather to cut interest rates. And that is where the problem is right now. Inflation is not going away just yet as far as the Federal Reserve is concerned, because the Fed chairman last week told us that he is very concerned that Trump's tariff policy may actually reignite inflation. So he is going to keep an eye on the outcome of these various policy, because we have not seen the full impact of Trump's tariff policy. Okay, over the next few months, hopefully we get some clarity on this sector here, as far as whether Trump's retaliatory tariff policies on its trading partners will result in higher retail prices. So until the Federal Reserve is convinced that the impact on inflation is not going to be devastating, then maybe there is the possibility that Federal Reserve may at some point continue to cut interest rate. As it is right now, the market do expect the Federal Reserve to cut twice. Okay, so we will have to see will it happen in the first quarter. First quarter is almost done, and we all knew that during last week's FOMC meeting, he did not surprise the market by cutting interest rates. So now the focus has been shifted to second quarter, which is Q2, as to whether the Federal Reserve will continue to cut interest rates. My bet is that it may only happen, if it happens, likely to be in Q3, if not Q4 of 2025. Okay, so this is the background. Now, last week, he made a few statements here. He says, we understand that sentiment is quite negative at this time, and that probably has to do, as you know, the turmoil at the beginning of an administration. What he's saying here is Trump's tariff policy. It's making, big policy changes in area of policy, and that's probably part of it. So what he's trying to do is to say here is that Trump's tariff policy has been very disruptive, and he wants to also see what it will lead to, whether it will lead to further negative impact on investor sentiment, which currently is the case, because we knew the US equity markets peaked last month, and it has been coming down rather aggressively over the course of 30 days. Okay, so we are beginning to see a big drawdown in equity prices compared into 2024, in which the market closed the year at a high. Okay, so again, this policy statement that the Fed Chairman Jerome Powell has been making this past week, it's still reverberating through the marketplace. He also says, and what I mean here is Powell, he also said there's always an unconditional possibility of recession. Now, this is the first time he is talking about the R word, okay? Now, we all knew that if Trump's tariff policy results in slower economic activity, it will possibly lead to a recession. So this is also another talking point as far as investors are concerned. They are not only concerned about the very stubborn inflation, they are worried about Trump's tariff policy will result in higher domestic prices, and that may possibly lead to a recession. And Trump's tariff policy may not only impact the United States, it may have a global dimension, which possibly will lead to a global recession. So this is the fear that the market is looking at right now. Now, the other thing that he also mentioned, Powell, he said the question is whether the current situation, those possibilities are elevated. Let me say the odds of a recession is obviously very much in play. So this is the other thing that he has mentioned this past week. Now, you also make this statement: uncertainty around the changes and their effect on the economic outlook is high. So he has been very negative, and he's just been very cautious in trying to lower interest rate. Of course, if the US economy results in a recession, then there will be green light for the Federal Reserve to actually lower interest rate to save the day. Okay, so I think that is the other thing. If inflation is controlled, like what the figure has been suggesting, then he will have more leeway to lower interest rates. But he doesn't want to lower interest rates too fast without knowing whether the tariff policy of Donald Trump is going to result in a reignition of inflation. So he wants to observe for a couple of months, and if the US economy actually result in a slowdown in economic activity, that will mean that there will be recession, and only then he will have a free hand to lower interest rates. So right now, nobody knows as to what will happen, but by and large, the sentiment in the marketplace has been pretty poor. Okay, in fact, the US equity market has been a poor performer so far in this quarter. Okay, elsewhere in Europe and in Asia, especially in Hong Kong and in China, equity markets has been rallying. We just ended the week with the DAX, which is the German equity index, at all-time high. So we can see that while Europe is trading at or near all-time high, the United States has actually been trading the opposite direction. So much so that the S&P 500, which is very much a retail equity index, has at one point fell more than 10% so far from its peak. And we also saw the Nasdaq 100, which was the darling of investor last year because of all these talks about AI, has actually fallen worse than the S&P 500 by more than 14%. So we also saw that towards the end of the week, on Friday itself, market has rebounded somewhat, but by and large, the sentiment is pretty poor. So today the topic is that, okay, inflation, the Federal Reserve likely reaction, and how the market is perceiving these changes in the marketplace. Okay, so this is the Fed fund rate. Now, the Fed fund rate refers to the interest rates the Federal Reserve charge the commercial banks in the States. We can see at the peak itself, the US maintained the Fed fund rate, which is the commercial rates, at 5.5%. Okay, it has since come down to 4.33%, and that has been a step down from a very aggressive monetary policy in which the Federal Reserve tightened interest rate from near zero all the way to 5.5% and keep it there for many months before deciding to cut interest rates towards the third quarter of last year, and that result in the Fed fund rate currently trading at 4.33%. Okay, so this is the posture of US interest rates. Are we likely to see lower interest rates? Like I said, the condition for the Federal Reserve to cut interest rates can only come if inflation is not running away or re-accelerating. And of course, we also need the US economy to get into trouble, like, slipping into a recession, before the Federal Reserve will have the green light to actually cut interest rates. So for now, we are likely to see 4.33 Fed fund rate at the current level for a little bit longer, because we are still waiting for data sets. Remember, Donald Trump has only been serving his second term for only more than slightly 2 months. So his policy may still be filtering through the economy, and we may likely only see the result in the months ahead. So in the meantime, interest rates in the States is likely to stay at current level above 4% for the time being. Okay. Now, this is the reaction in the US equity market. This is up to last Friday. We can see the S&P 500 is the most popular retail equity index tracked by American investors. We can see that the peak itself was only slightly a month ago. On February the 19th, the S&P 500 hit an all-time high of 6,147.2. Now, this is a data set from the IronFX MT4 MT5 trading platform. Obviously, it does not reflect the cash index, but it is as close as we can get. Okay, so on February the 19th, 2025, which is last month, the S&P 500 hit an all-time high of 6,147.2, and it has came down by more than 10% as of last Thursday. So we can see the market has come down quite aggressively. To lose 10% in just slightly over 30 days is huge. Okay, but that can only be seen in the context of the rally that we've seen in this index since the low in the COVID period during 2020. The market hit a low just above 2000 in March of 2020, okay, at the peak of the COVID lockdown. And since then, the market has actually more than tripled. Okay, so it has come a long way. So we have a 10% decline on the back of a 3x rise in the index. So we got to see things in perspective. That means to say that this market is very much still in the bullish phase. And what we are witnessing right now, although the market has come off quite fast, we also have to see in the context that it is part of a possible correction. There is no sign that this is likely to result in a crash. Okay, so but like I said, the market has come down so fast in a very short period of time that has risen some fear in the marketplace. But by and large, when we look at the from the perspective of a 3x increase in the value of this index, and we're only seeing a slightly over 10% a decline so far. Okay, that does not mean that we are likely to see a major catastrophic collapse in the equity markets. Okay, like I said, the US equity market is behaving a little bit unusual relative to, let's say, Europe or even Asia. Okay. Now, as far as the Nasdaq 100 is concerned, the Nasdaq 100 is actually a very tech-heavy index. Now, of course, we all know the parent index is the Nasdaq Composite. We have a lot of US companies listed on both the Nasdaq Composite and the S&P 500. So there are common stocks listed in two different exchanges measured by two different equity index. Okay, so the Nasdaq 100 is actually a subcomponent of the Nasdaq Composite, and we can trade this index. Okay, not only is this index available for trading on most of the OTC brokers, such as IronFX, we are also able to trade the Nasdaq 100 as a futures contract in Chicago. Okay, so here we have seen slightly, okay, one day before the S&P 500 peaks out, okay, we noticed that the Nasdaq 100 actually topped out 24 hours before the S&P 500 at 22,236.3. Again, this number is the number reflected by the pricing in the IronFX MT4, MT5 trading platform. If you trade other OTC product in other OTC brokers platform, this number may actually shift a little bit. But by and large, you can see that the market peaks on that day on February 18, 2025. And to date, as of last Thursday, the market has actually fallen more than 14%, although we do get a little bit of a bounce on the last trading day last week. So this has been a lot more volatile, but this is understandable because leading to the all-time high, which is last month, the market talks about everything AI, everything has pivoted to online. We noticed during the pandemic lockdown, we all bought a lot of electronic devices and equipments. Basically, we need to pivot to do a lot of things online since borders are closed. And the talks of tech stock has been very rampant. We can see that the index bottoms out at about the same time as the S&P 500 in March of 2020, and that has also seen quite an aggressive move. Okay, from just above 2,000, it was at 22,000. So you can imagine the magnitude of this rise. So right now we are only seeing 14% pullback from this all-time high. So again, in the same thing as how we look at the S&P 500, we are viewing this pullback as deep as it was at 14% is part of a corrective pullback. There is no sign that the market is about to experience a catastrophic crash just yet. Okay, so until we see further evidence, we are not likely to see such an adverse reaction. Although this is also keeping a lot of investors very, very nervous because of their overvaluation perceived by investors about tech stocks. So it's only natural that the tech sector see a larger than normal pullback compared to the other major equity index here. Okay. So this is just giving you some kind of a perspective, okay? And as far as the dollar concerned, okay, many platforms do not allow you to trade the dollar index. It was available at one point in time on the IronFX trading platform, but that has been delisted. But we can see from the dollar index, which is basically a basket of currencies that the United States trade with, such as the euro, the Japanese yen, the Canadian dollars. Okay, so those were in the basket. However, while it is a basket of US major trading partners, this basket itself that make up the US dollar index does not have the RMB, which is the Chinese yuan, okay, which is a little bit peculiar because the US trades quite a fair bit with China, and with the RMB not included in this basket is, to me, a mystery. Okay, but anyway, we can see just by looking at the price level of the index itself. Now, if the index goes up, it means the dollar is stronger. If the index pulls down, it means the dollar is weaker. We have seen to date, okay, at the lowest point this year, the dollar index has come off by 5.78%. So we knew that the dollar is weaker, very much in line with what Donald Trump has always been advocating, that he wants a weaker dollar so as to make the US export more competitive. But largely, he wants the Federal Reserve to lower the interest rates, and that will also have the same effect for a weaker dollar. Okay, but when Donald Trump launched his tariff policy, theoretically, we should see a stronger dollar relative to all the countries that has been hit by his tariff policies, such as the Canadian dollars, such as the Mexican peso, and to a large extent, the Chinese RMB. So if you are the subject of a tariff policy, meaning to say that a major a major trading partner like the United States impose a tariff on your goods and services, that currency, that country's currency should theoretically be weaker. Okay, but what we are witnessing here is not exactly how it's supposed to pan out in theory. Okay, what we are seeing here since at the beginning of the year, you can see that the peak here in the dollar index is at 109.53 one day after the new year for 2025. Since then, it has been coming down, and this is a little bit of a perplexing thing that we are looking at. So we are saying, generally speaking, the dollar remains in a somewhat bullish phase, although we have been seeing sideways movement in the dollar index trading. Okay, so with a little bit bias to the upside, or even though largely the market has been moving sideways. So the underlying strength in the dollar is very much in place. So do not believe that the dollar is weak. The dollar is not weak, although we have seen so far after 25 days of trading, after almost 3 weeks of trading, I'm sorry, that the dollar has been coming down, but that does not suggest that the dollar is inherently weak. In my opinion, I believe in the dollar being strong going forward. Okay, what I'm more concerned is that the major currencies such as the euro, the sterling, the Japanese yen, maybe not the Japanese, but I think the RMB will be seeing further losses ahead. So just be aware of the underlying strength in the dollar. Okay, now the outliner here has been gold. Okay, while the other major asset class such as equity markets and the dollar has been less than ideal so far, gold has been going from strength to strength. Okay, we have seen gold quoted in the spot market above $3,000 per ounce. This is a record high. Now, the highest traded was on February 18. So we can see the price has hit more than $3,000 per ounce. Now, the question on everybody's mind is that will these gold prices continue to escalate higher? This is the interesting part, because later on, when we look into the gold prices, if you choose to ask me to share my views on gold, I will be sharing with you, and I have a very contrarian outlook on the price of gold. Okay, but so far, gold has been massively higher. And not only is it trading higher in the spot market, it's trading even higher in the futures market as far as the COMEX gold futures are concerned. Right now, the spot gold market prices are trading at a discount to the premium are quoted by the futures contract. It means the paper gold right now is currently trading at a premium relative to the cash market. Okay, and that has also resulted in a arbitrage opportunity, which resulted in so-called movements of gold from London, which is the largest market for the trading of gold, have been shifting. A lot of people are asking for delivery to be sent the gold from London to New York by the plane load. Okay, so there are certain things that are moving, and of course there are speculation as to why the United States is suddenly importing so many gold back to the United States. Something is happening, okay, just that it is not in the media. Nobody truly knows what is the reason, but I have my suspicion on a few factor. Okay, later on we will go into that, and if we talk about gold, I'll be more than happy to share with you my take. Okay, here, like I said, I'm going to do away with the usual me showing you all the products, all the financial assets that I want to show you. So here there are four major categories. We have equity markets, we have Forex, which is currency. We also have commodities. We're going to limit it to those commodities that are available for trading on the IronFX trading platform. And of course, the digital assets such as Bitcoin, Ethereum, Ripple, to the extent. Okay, so you let me know what you want me to talk about. Now let's talk about equity markets. Do you want to know any particular markets? So if you have if you have something on your mind, just type that into the Q&A so I can address those as we go along. Would you like to do that for me so that we have a little bit of interaction rather than I just vomit on you what I want to show you? Okay, the Dow. Okay, let's talk about the Dow. Thank you very much. And Raja Kumar, one Nifty. Unfortunately, there's no Nifty available on the platform here. Yes, let's deal with equity markets first. Okay, the Dow and Hang Seng. Yes, so far we also have the Hang Seng available for sharing. Let me see. Nasdaq. Okay, Nasdaq and Hang Seng. Okay, so basically I will talk about the Dow and the Nasdaq for now. Then later on we go over to the Hong Kong market. Okay. A50 is not available on this platform, unfortunately, so I can't share with you my outlook on the Chinese equity market. I will also talk about DAX. Very, very good. So, okay, let's get into it. Let me share with you my chart first. Okay. So the Dow. Let me know if you can see my chart here. Okay, here I have a few windows open. I want to show you the bigger time frame, which is the monthly time frame. So ignore this remark that I put on my chart here. So we can see this is the monthly time frame, and this is definitely not the longest historical data that I can show you, but on the IronFX platform, this is all that I can show you. So we can see that the market is in that bullish phase, okay, to a high of 45,078. We can see the high was traded 5 months ago. So in terms of the Dow Jones, which is the premier index followed by fund managers, we do not have a new high for quite some time now. Okay, the market has been trading basically every month into a new high for the large parts of 2024, but that stopped. Okay, 5 months ago on November of 2024, and the market peak was at 45,078. Since then, there were 3 other attempts to take out this high, but all 3 in the following months failed to take out the all-time high, which resulted in this month. So far, we're only in the 3rd week of trading for this month, and we have seen that the market has sell off after failing to take out the all-time high. So this is a bit of profit taking. So as far as the international investors, the fund managers are concerned, they have stopped chasing US equity markets, and they have obviously been pivoting and trying to take out their maybe some profit taking and take out cash to reinvest in places like Europe as well as in Asia, because both Europe and Asia currently are trading very, very well relative to what we are seeing on Wall Street. So there's a bit of substitution going on, people taking cash out of Wall Street and redeploy them in Europe as well as in Asia. And we can see later on when we talk about the Hang Seng has been very, very has been doing very well this year. Okay, but in terms of technical outlook, we may have possibly hit a pocket of air. Okay, so later on when we talk about the Hang Seng, I will show you why I say that. Okay, so as far as the monthly time frame is concerned, the Dow Jones is very much in the bullish phase with a little bit of consolidation and some profit taking on right now. Okay, so we also look at the weekly time frame. So this is a weekly time frame. It has more data. We can see a bit of a corrective move, and notice that this move from the all-time high of 45,078 has actually unfolded in somewhat of a three-wave pullback. Now, I have introduced this concept of a three-wave pullback. Now, as far as pullbacks are concerned, there is always the case of a symmetrical three-wave pullback, meaning to say the first leg of any kind of correction is likely to result in an equal distance for the second leg. So here we have a 1, 2, 3 move. Assuming this is A, this is B, this is C. So we can see that this move here is a ABC move, which typically result in an equality move. Down here we can see the equality move is somewhere at 41,625. So if we have seen the first wave and subsequently a failed attempt to take out the all-time high, which resulted in another drop, that can be extrapolated ahead of time before the market hit unfold in a three-wave. Okay, so as the market is coming down, you can actually largely make a guesstimate as to where the market may bottom, but most likely it will take out the most recent low, which it did. Okay, the week before last, and the market has moved slightly beyond equality to as much as 123.6% extension of its initial leg. So this result in a three-way pullback, which have possibly bottomed out. So what's going to happen going forward could be this could end up, if this is a simple ABC move, then the market is getting ready to resume its up run. Okay, whether or not that is the case, we will not know. Okay, we will have to see. We'll look for clues on the other equity index to see if we have a corresponding equality move in the pullback so far. So in the simplest form, a three-way pullback would have minimally satisfied a corrective move. Okay, if that's the case, then the market should logically resume its bull market to take up the all-time high of 45,078 over time. Okay, but that may not be the case because this pullback could result in a more complex corrective pattern. Now, this is the most simple of simple corrective pattern, and it could result in something a little bit more complex, such as two sets of three-wave pullback or three sets of three-wave pullback, or it could result in something else, such as a triangle pattern, for example, and those are part of corrective pattern. So it is a little bit premature to say that the bottom is in place and the market is getting ready to resume its up run. Okay, it may be the case, but we still need evidence. Okay, so in the meantime, we can only classify this move here as a three-wave corrective pattern. Now, if you look into the daily time frame, that is also the case. So this is the daily time frame. You can see this three-way pullback is very clearly play out. Okay, so right now we have more than slightly over a week of a rebound. On Friday, the market has a very strong reversal here. You notice that this last candle bar here on Friday, you can see that the market has at one point in time traded fairly low, and it closes on a strong note. So on this candle itself, it's largely a very bullish reversal pattern, suggesting in the near term, likely to be in the first 2 days of trading for, let's say, tomorrow and the day after, we possibly will see follow-through buying in the Dow Jones. So that is putting a somewhat bullish foundation under this latest move here. So if we do see follow-through buying, do not be surprised. How you want to trade it for those who are trading on a lower time frame, it definitely have the condition for trading higher by tomorrow or even the day after. So this is actually laying the groundwork for an extension of this recovery on Friday. Okay, so by and large, near term, it is supposed to be slightly stronger on the upside. Okay, so when we look at the Nasdaq, okay, the Nasdaq, which is the tech stocks index, okay, the tech index. Again, we want to look at the monthly time frame. We are seeing the same thing here. Historical data can only bring us so far. And on this platform, you can see the high is traded at 22,236.3. Okay, and this was only in February. Okay, remember the high was traded on February 18, one day before the S&P 500 peaks, and definitely this market has followed through buying despite the Dow Jones not having a new high for 5 months so far since November of last year. So we can see that there's a pullback here, not very clear in the sense that we cannot see a three-way pullback on the higher time frame such as the monthly. For that, we have to go down maybe one time frame lower to see if we can detect any kind of three-way. So far, there is no three-way pattern, it's just one wave. It means to say that this decline here may possibly has bottomed at 19,110. Okay, but again, we do not see that being the confirmation so far. We need to see confirmation in the lower time frame. But at least for now, there is a very good likelihood that this could be part of the first wave of decline, be followed by another rally, not exceeding the all-time high at 22,236.3, and is eventually, if this is going to be a three-way, we should see another decline to take out this low here at 19,110 over time. Okay, so there is a possibility that what we are seeing here could be the bottom for the first leg of a corrective pullback, to be followed by a rebound not exceeding 22,236.3, to be followed by another leg down, likely to take out the 19,110, which is the current low. Okay, so again, we want to see further evidence of that. We want to go down to, let's say, the daily time frame to see if we can see the possible of a rebound. Here we can see that this is the daily time frame. For more than a week now, the market has not been registering fresh low. The low remains at 19,110, and this low here was traded on March the 11th. Okay, so there is a possibility, what we are seeing here, that the rebound has been very tentative. But again, notice how this last candle bar looks like. Okay, at one point it was trading here, and by the time it closes on Friday, it actually closed above its closing price on Friday, setting the stage for extension rally. So at least in the near term, we could see that the Nasdaq, very much like the Dow, has a possibility of taking this rebound a little bit higher, at least in the first 48 hours of trading in the new week. Okay, so near term, do not try to sell this index, because we have seen evidence on the daily time frame that it has a classical reversal signal here in this as the market closed on Friday. So near term, it will definitely be a little bit biased to the upside. For those trading short term, you can take the advantage maybe to follow through on the upside. But again, this is part of a rebound, okay, within a corrective pullback. So again, this is how I think the market is playing out right now. Okay, Raja Kumar also wants to want me to talk about Nikkei. We'll do that. Okay, so now let's move to DAX, which is the German index. I actually made a remark earlier on that the DAX is at an all-time high. Okay, so this is the movement in the German DAX. Very, very strong. Okay, technically, this market is very, very strong. This is in the face of very weak economic data. Germany is definitely in recession, but the equity markets is not showing that. In fact, there is a lot of buying of German equities, and that has a lot to do with the election that we saw last month, in which a new party now is running Germany. We have a new chancellor in place, and his policy is very much to open up the wallet to spend. And Germany has always been the very conservative in terms of their monetary policy, in terms of the fiscal policy. They have been very disciplined. They do not want to spend more than they earn. Okay? And that has been the case since World War II. So for the last 70 years, Germany has been very disciplined. But I think that things are changing, because for more than 3 years now, the war in Ukraine has resulted in the unexpected decline in German productivity. We can see that Germany economy is reeling as a result of no more access to cheap, affordable energy sources. Now they had to depend on buying liquefied natural gas from the United States and Qatar, which are priced definitely at a premium. So that has also resulted in a wave of industrialization in which German companies are actually exiting Germany to relocate somewhere else. Typically, they will go to two places. They will seek out a place where they can operate, where they are assured that there will be energy, affordable energy, or at least the availability of energy. And that means it is the United States. Now, the other place that German companies may pivot to is actually where their market is. And that means some of them have actually decided to move their operation to China to better serve their Chinese customer. So either the German companies are leaving in droves to the United States, or they are moving in droves to China. And that has resulted in lower economic output, and that should theoretically means lower equity prices. But this is not what we are seeing here. What we are seeing here is that equity prices has got a boost since the new chancellor come into power, and he says that he wants to retool the economy, and factories like those owned by Volkswagen has now been repurposed to produce military equipment such as tanks. Okay, so that has also resulted in a wave of buying of Germany stocks, and that has seen the index itself powering the all-time high. Okay, so this is something a bit peculiar, where the equity markets is trading all-time high despite the economy being in recession. So sometimes you have to understand why this is the case, because it does not always develop in such a way that as textbook perfect. Okay, here we have to understand the nuances behind the reason why German equity markets is on a tear. Okay, because investors believe that if the Germany starts to open up their wallet to spend, that will result in an expanded economy. There will be a lot more economic activity, especially now that Germany is among the few major countries within NATO that wants to support Ukraine by not only in terms of money, they also want to supply Ukraine with the necessary military hardware for them to continue the fight against Russia. So this is big, because it will mean that the war in Ukraine is very likely not able to slow down. Okay, there has been talk of ceasefire, but I think the Russian has already said ceasefire is to them irrelevant, because they fear that the NATO will rearm Ukraine during the 30 days ceasefire that has been the talk of town right now. Okay, so despite the effort to bring the war in Ukraine to an end, on the ground itself, we do have situations in which there are countries within Europe that wants to continue the fight. And that means to say that they will have to produce more weapons for Ukraine, and not only supply Ukraine with more money, they also need to supply them with more equipment and perhaps even troops. Okay, and if that is the case, if there are boots on the ground in Ukraine from NATO countries, that will change the dynamic in the war, because Russia has always viewed that if any military, if any NATO countries actually supply troops of their own to fight the war in Ukraine, that means it will be an all-out war between NATO and Russia, and that will be complicating the outlook for a lot of asset classes. So just be aware of the situation. So this is the monthly outlook. Okay, let's take a look at the weekly time frame. Here we can see that the market has a fresh high this week itself. The all-time high is 23,477.5, and unfortunately for the week itself, the market ends like this. Now, this is definitely not a very positive development, and we want to see if this is suggesting to us that perhaps a temporary high is already in place in this index, or the market is getting ready for a pullback. Okay, and that can only be seen in the lower time frame, such as the daily. For example, we can see that for the good part of the past week, we can see the market, even though it has an all-time high on Tuesday, did not result in follow-through buying for the next 3 days, which end up on Friday. The market actually seen a pullback here. So by and large, we have a bit of a disturbing outlook here. Here we have an all-time high here on March the 6th, 23,474.4, and we have a marginal high which see no follow through. So this high here that we saw on Tuesday could be part of a fake move, meaning to say the market is trying to trigger a lot of buy stops here. Now imagine during this phase when the market had an all-time high at 23,477, 474.4, it resulted in a pullback. So those who have sold will logically put their stop above this all-time high. So this market subsequently rallied back to take out this the previous high on March the 16th, just by a little bit before it turned back down. So this could be trying to trap those who have gone short, okay, earlier on. So now the market is coming back down, and this is disturbing because it looks and smells like a trap, okay. So meaning that those who have short now will be caught with buying at an all-time high, and prices has since pulled back. So this is setting the stage for potential correction. So if this is a correction, so far we can see the market, although it has traded to all-time high, it has been struggling going higher. And the fact that it has only a marginal high before it pulled back down smells like a trap. Okay, so this is setting the condition for further decline in the German DAX. So just be aware of that possibility. Now, if you want to see further evidence, go down one time frame lower, which is the 4 hours, to see if that is the case. Okay, are we able to see some kind of a setup here? Okay, here we have the all-time high, which is marginally higher than the previous one, and then followed by a pullback. So right now we do have a counter trend pullback in place, and there is a possibility we may see lower prices, not necessary to flip this entire bullish outlook. Okay, so far we do not have evidence. So if you look at a 4 hours time frame, the level to watch will be 21,725.5. If the price goes below here, that will be the first clue that something more sinister is at play. Okay, so for the time being, all I can tell you is that it looks like a bull trap. Oh, no, sorry, it looks like a bear trap. Market people who have sold, put a stop here, now has been stopped out, end up buying here, and now the market has pulled back. So now we want to see if this will eventually end up as a bull trap as well. Okay, so if you have a choice not to engage this market, maybe it's a good idea to step aside and watch how the market plays out. Okay, if the market wants to flip, okay, look out for this level at 21,725.5, and maybe that's the best thing you can do. Okay, stand aside and let the market tell us what it wants to do. Okay, now the other thing that you want to watch was the Nikkei 225. Okay, let me show you the Japanese market here. Again, we'll be looking at the monthly time frame. Here we can see that the Nikkei has been struggling. The market traded to a high of 42,484. Okay, we have not seen Japanese equity markets at all-time high for many, many years. But last year we saw the Japanese market manage to trade to an all-time high. Okay, fresh all-time high at 42,484. But over the course of the next few months, we can see that for 2, 4, 6, 8 months since, the market did not even go anywhere near the all-time high. So the market has been struggling, but it's not giving up, because there are many attempts where the market was trying to stay above 40,000. The last time it did that was actually 3 months ago in January. The high traded was 40,608, but since then, from February, from March, we can see lower prices. So by and large, this market, technically speaking, is still very bullish, okay, but it has been struggling longer than the rest, okay, including those on Wall Street. Okay, obviously it's not trading all-time high, but it is not exactly flipping over. Okay, so again, I think the market could be in a period of consolidation. We want to see the weekly time frame. You can see that the market has been bunching, okay, very near to 40,000 with no sustainability above 40,000. The market since has been disappointed, and it has since seen a bit of profit taking. So by and large, this is not a case whereby the market has topped out and is getting ready to collapse. There's no sign of that. Okay, we need to see evidence of that if the market goes down. If the market wants to flip and come down, it will tell us over time. For time being, the Japanese equity market does not look like a good place to be in right now, because there is no sign that it's going to recharge into new all-time high or is about to come off aggressively. So it's just treading water. So if I am a very active trader, maybe I will give the Nikkei 225 a miss for now until things clear up in terms of where the market wants to go. Okay, here we can see that there is a counter trend in place. And remember this line that I've shown you over the last few weeks, okay? This line is an imaginary line which I try to link with the most recent bottoms here, resulting in a support. Every time the market comes and touches line, it bounce, touches, bounce. But there was this day on February 21st, the market broke the line, closed below the line, and never since able to go back in. Okay, there were two attempts in the aftermath of the breaking of the support line, but the market never quite closed above back into the line. So we can see that the market has been trading below this red color line. Now it's a case whereby this line here now becomes a resistant line. And although the market has rebounded somewhat, okay, we want to see the reaction as and when it comes nearer to this line here, which was previously the support line. Now it could be potentially a resistant line. Okay, so by and large, we do see that there is a bit of a corrective move here, but there's no real sustainable move in either direction. Like I say, I won't want to touch this market for the time being if I can afford to stay out. So this is the Nikkei 225. Let's take a look at the Hang Seng, where the action has been since the beginning of the year. Now, the Hang Seng market has been trading relatively well last year, okay, and it actually has caught a second win at the start of this year itself. Okay, let me show you the monthly time frame. Now, the monthly time frame suggests that the Hang Seng is in a bearish dominant trend, meaning to say that the overall sentiment in the Hang Seng is tier one, in which prices are likely to come down further rather than go up. Okay, but what we have witnessed since is that three-wave rally. Okay, this three-wave rally hit the what you call that equality level. You can see the equality level was at 14,852.35. Okay, it hit that marginally, and that has been this month so far. So we have seen a three-wave rally here, which theoretically means that a top could be in place. If this is a symmetrical three-wave corrective rebound, very much like the three-wave pullback that we saw in the let's say the Dow Jones, for example, this is the exact mirror image. This is a corrective rebound within a bear market, and the market has hit this equality level at 24,500 thereabout. Okay, the high traded was 24,505. Okay, it's not exact science, but it does give us a target to aim for, and the market hit this magical number, and since there has been a bit of a resistance. Okay, so on the monthly time frame, we see the possible ending of a technical rebound, and if this is the case, in its simplest form, it will mean the market will resume its bear market, eventually take out the all-time low here. Okay, so we will have to see. So far, we are not able to see any evidence of that just yet. Let's go down to the weekly time frame. Okay, now the weekly time frame result in a move to as high as 25,000. I believe it's 25,000. 25. Sorry, almost 25,000. 24,900.5. And this ends on a somewhat weak note. You can see that for the entire week itself, this is the lowest it has closed for the past 3 weeks. That means to say for the month itself, this is the lowest closing so far. And this is definitely not a good development, because the market hit a three-wave bounce near equality, and in the weekly time frame, it hit this pocket of prices, which is what we call the very deep retracement levels, and the market result in a move like this. So this is potentially suggesting to us that this rally that we see in the Hang Seng could potentially hit an air pocket. Now, the story behind why the Hang Seng has been so strong relative to what we're seeing on Wall Street has been the fact that the AI narrative, which was centered on NVIDIA the whole of last year, has now suddenly pivoted to China ever since DeepSeek came in with a very competitively priced AI model, okay, which can basically do what OpenAI does, but at a fraction of the cost. Okay, and because it's open source, that means to say that most people can use their model for free, and that is killing the business model for OpenAI. Okay, and that will also impact the share of NVIDIA, because that means to say that if the Chinese AI guys can make do with fewer NVIDIA chips, there will be a negative impact on the share of NVIDIA, meaning that people may now realize they don't need to spend tens of billions of dollars on NVIDIA chips, and this will have a negative impact. Okay, now on the daily time frame, Can we see something more sinister? Okay, we have seen 3 days in which the price has been closing lower. That came about on Wednesday midweek. Okay, we have a high for the year, resulted in a marginal close, which is lower on Tuesday, and then followed by Thursday sell-off, Friday sell-off, and this could actually put the stage for further sell-off in the Hong Kong market. So if you are still holding on to long positions or you're holding on to Hong Kong equity shares, then maybe you want to take some money off the table by looking at this equality move in the monthly and the weekly time frame. It does suggest that technically speaking, the Hang Seng market may have hit an air pocket and may see some disturbances. Okay, so this is my take on the Nikkei. If I can avoid, I will avoid. Hang Seng, if I'm still long, I want to take profit. And yeah, that's about it. And in the meantime, we want to keep an eye on European stocks as far as DAX is concerned, because we have a potential fake move that just occurred, and we are not seeing, we possibly could see the end of a corrective pattern pullback in the Dow Jones, but that is not evident in the in Nasdaq 100. So it's not congruent. We don't see similar pattern in the Nasdaq. So the Nasdaq may bounce, but it may not likely end up with a resumption of the bull market. So equity market, in my opinion, is not a good place to stay in right now because the market trend is less than clear. Now, for the other group, do you want to see currencies? Which currency pair would you like me to show you other than gold, which I will eventually cover? Can you let me know which currency pair you want me to talk about? Let's limit it to the majors. I don't want to talk about crosses. That means to say there will be too much for me to share. Okay, I will limit my share of outlook in the currencies for the major pair, such as the euro dollar, the sterling, the Aussie. Anything? Jim wants to see euro dollar and dollar yen. All right, let's do that. Now, the euro dollar has seen a bit of a pullback of late this week. Okay, now again, we will look at it from the higher time frame, which is the monthly time frame. Ignore this remark that I put up here. Okay, I'm sorry. Okay, here what we see here is that the dominant trend in the monthly is telling us clearly that the euro is in a long-term death spiral. Okay, the bounce that we see here from the low here at 95 cents to the dollar is part of a potential three-wave rally, very much like what we saw in the Hang Seng. Okay, so this three-wave bounce could actually extend higher beyond 113. Okay, here the high traded is 1.1275. So if that is true, this is potentially the first leg, and this also resulted in a three-wave pullback, which bottomed out at 1.017. And we can see so far this month, for the month of March, we can see a very strong recovery in the euro, which suggests that we are possibly looking at the second leg of this corrective rally here, with a target anywhere between 1.19 to 1.23 to the dollar. And 1.23 is interesting because that is where the last swing high was, which was last traded on January 2021. Okay, so if the market do rally as deep as far as 123, just understand that in January of 2021, we have a high here that has not been challenged. So this could be a very natural target to gun for. So this is potentially part of a three-wave rally. Now, this rally does not suggest that the euro is going to be strong for any sustained period of time, just suggesting that it is part of a corrective rebound, meaning to say that once this corrective rebound is over, the larger dominant trend will re-exert its influence, causing price of the euro to eventually go lower than what we see here at 95 cents to the dollar. So this low here is actually, it's a matter of time that it will be taken out. So we want to see when that is the case. Okay, so this is the larger picture. Let's take a look at the weekly time frame. We can see that the week before, at the start of the month itself, there was a very strong rally in the euro dollars that has also saw follow through rally in the euro, which resulted in the first closing that has been lower for the last 3 weeks. Friday's closing, okay, is actually the lowest of the previous 3 weeks. So that is putting the stage for a little bit of corrective counter trend within a counter trend. Okay, we have this rally here, part of a three-wave rally. Okay, and this looks like over time we will probably see another extension of this move above 1.1275. Okay, targeting anywhere between 119 to 123. Okay, so eventually, right now in the immediate term, we could possibly see a little bit of weakness when the market reopens tomorrow, and at least for the first 48 hours. So we can see here on the daily time frame, we have 3 days of continuous losses in the in euro dollars. Okay, and the high traded is 1.0955, followed by 3 days of losses, and near term is starting to continue to ease back. So anywhere between, let's say, 106. This 106 is actually the 50% pullback rally of this entire move from 102, 102.80 to 109.55. Okay, so near term, there's a possibility the market will come back into this area, possibly targeting 106. Okay, so if the market do come to 106 level, look out for stabilization of prices followed by a potential reversal on the lower time frame. And if you do see one, I think we can take a look at possibly rejoining the buying, because near term to the medium term there is possibility the three-wave rebound in the monthly time frame will eventually see prices going back to retake the 112. Okay. All right, this is euro dollar. Let me take a look at the dollar versus the yen for you. So we can see in the dollar yen here, we can see dollar has been very, very strong relative to the Japanese yen, which peaked out at 161.95, and that was in middle of last year. In July of last year, we see dollar yen traded to a high of 161.95, and followed by an intervention by the Bank of Japan, basically selling dollar for yen. Okay, and that has resulted in a drop in the dollar yen rate to as low as 139.58, followed by another bounce to as high as 158.88. Okay, that was 3 months ago. At the beginning of this year, we can see that the dollar went back up, but not quite able to take out the all-time high at 161.95. So that has seen 3 months of pullback. So right now, what we are seeing here is potentially this is a three-wave pullback here. So if this is the case, then the low here at 139.58 will eventually be exceeded. Okay, so if this is the case, there is a possibility of equality anywhere between 136.50 to 131.40, 131.30. Okay, so anywhere between these two areas here, between 131.30 to 136.55, the market could actually eventually settle somewhere in between here. And if this is assuming that this is a regular simple pullback, so this will be the target area over the medium term. Okay, so if you are looking to sell the dollar for yen, that could be something that you can actually take a look at. Okay, now the weekly time frame. Weekly time frame is showing us very clearly that this bounce here from 139.58 is also a three-wave rally. Okay, this is definitely not symmetrical, but it also stopped going higher within these very deep retracement levels between 157.60 to 162. Okay, so prices has been coming down quite consistently, except for a bit of a bounce over the last 2 weeks. So in the daily time frame, again, the outlook is less than clear. The rebound so far from 146.53 has been very, very shallow, very likely to extend higher to anywhere just under 151. Okay, so if we do see a bounce back into this area, I am not of the opinion that we should be buying this. Okay, because overall the dollar index, as we can see, the dollar index is actually in the phase whereby it's actually losing value. Okay, although the dominant trend in the dollar index suggests that over time, in the monthly time frame, it is actually in the bullish phase. But there is no clear outlook as to how the dollar yen does look like. We can only refer to the monthly time frame, which suggests, or even the daily, even the weekly time frame, that this is part of a corrective move that will eventually see prices coming back down below 139.58. Okay, this low here does looks vulnerable. Okay, so if this is the continuation of this three-wave pullback, prices will eventually go below 139.58. So I am not of the opinion that I should be buying this index here, or rather this pair here. If anything, I would be looking for opportunity to trade on the short side by going down to, let's say, the lower time frame. If the opportunity present itself and if the risk can be controlled, then maybe that will be the case. Okay, so far we have a three-wave bounce. Three-wave bounce. This is based on a 4 hours time frame, and the market actually managed to catch this fall here between 142 to 148. Okay, the low traded is 140, 148.18. It's a little bit complex. Okay, so I am of the opinion if the market can go higher, I will try to see if I can find a low risk area in which to engage the market on the short side rather than a long side of this move. Okay, I hope that has been useful for you. Let me see what other question you may have for me. Uh, dollar sing, interesting. Okay, Tamdi wants to know. Okay, there's one. Kilon wanted to see Kiwi dollars. Tamdi want to see Aussie. Okay, let's talk about Aussie then. This is the Aussie monthly time frame. Now, this suggests that the larger degree, the higher time frame is telling us the Aussie is in a long-term decline. So we have a bit of a bottom here at 55 cents to the US dollars, followed by a bounce here all the way to a high here at 80 cents. Okay, followed by subsequent pullback. So by and large, this rally followed by a pullback not lower than 55 cents suggests that this is potentially a possibility of another rally coming up in the Aussie. And that also gels in with the immediate weakness in the dollar. Okay, so if we do see a bounce in the Aussie, can you buy it? If you can determine a low risk proposition, maybe that could be something to consider. Okay, but long term, just remember the Aussie is weak. Okay, but no currency continue to weaken forever. There will be time whereby it starts to look cheap and speculatively the possibility of bargain. Okay, so here we do see that the slowdown, okay, is only marginal. You can see this low here traded on the monthly time frame was actually in February, right? So this low here at 60, okay, 0.6088 is only marginally lower than this low here. This lower here is 0.6170. So you see that it's only a marginal low followed by a bounce. So again, this is very similar to what we saw in the DAX, where the market have marginal new high and then followed by a decline. So here we have an exact mirror image of the same move, but in the Aussie dollars. Here we can see a marginal low relative to its most recent low, suggesting that this is potentially a fake move. So right now on the monthly time frame, there's no evidence that there's a lot of buying going on, at least not evident in the monthly time frame. For that, we want to go down to the lower time frame to look for evidence that the money or the buyers are back. Okay, so far, do we see that? Yes, we have a very strong rebound followed by another week of very strong rebound. So again, this is quite interesting. If the market do come back into this bracket of prices, which I've highlighted in deep blue, okay, anywhere between 61 cents to 61.5 cents, that will be what I would consider to be a low risk environment in which it may actually be worth trading on the long side. Okay, at least for a bounce beyond 64 cents. Okay, so if your target is not for the market to recover back all the way to 70 cents, all you want to do is to trade this pattern here. If the market do this, go into this area where the dark blue area is anywhere between 61 cents to 61.5 cents. If you see a reversal on the lower time frame, maybe it's worth a while to take a position on the long side. That is something that I may consider if that opportunity arises. So we are not able to see that in the higher time, in the weekly time frame. Can we see sometime in the lower time frame, like the daily? Now the daily here is very interesting. Now I've shown you this price channel in the previous update. Here we have a move to the upside, hit by this pocket here. So the market is currently trading within this rising price channel. Will the bottom of this channel hold? We do not know. So far, it does appear that we don't have to wait very long. Tomorrow or at least in the coming week, we should be able to get some kind of idea if this lower end of the price channel can hold this pullback in the Aussie dollars. Okay, but what I'm seeing here is another possibility. Can you see this move here? if this is actually a three-way pullback, then there is a possibility market will go marginally below the channel bottom, followed by a move to the into this area here, anywhere between 61 and a half to 61. Okay, very much in line with what we saw on the weekly time frame. Again, this highlighted blue area is where the low risk area is for me. Okay, so if the prices eventually break this bottom in the price channel, do not go and sell it. I would not take this as a sell signal. Okay, in fact, I'm just waiting for price to eventually decline, and hopefully once it gets into this area between 61 to 61.5 cents, to look for evidence of buying interest coming back. That means to say I must look for a buying signal. If there's a reversal signal happening within this bracket of prices, in let's say the 4 hours time frame, on the 1 hour time frame, I will take my chance and go back into the market to buy the Aussie for that possibility of a bounce back above 65 cents, or at least to take out this high here. Okay, so that will be a very short-term play if that ever pans out. So this is my outlook for the Aussie dollars. So the Kiwi, let me take a look. I have not looked at Kiwi for quite some time because I don't trade this currency pair. So anyway, let's take a look. So this is the monthly time frame. Very much, it's actually quite different. Now, the Aussie is in a long-term decline. The Kiwi is not. The Kiwi dominant trend is actually up, and prices now are getting very, very inexpensive. So we have seen the low here is at near 55 cents, 0.5467. That low here was created in March of 2020. Okay, very interesting. This is the pandemic low. If prices continue to weaken into this bracket of prices anywhere between, let's say, 49 cents to 54 and 54.8 cents, I think that becomes on a relative basis quite cheap because the dominant trend is actually quite bullish. So that means if the price ever comes into this bracket of prices anywhere between 1.49 or not 0.49, I beg your pardon, 0.49 to 0.55, that becomes a very attractive area to reposition for the long haul, because the monthly time frame, unless this low is taken out, which is the 0.4893 is taken out, is more likely to be the case that this price will be considered to be a bargain. Okay, but we need confirmation. So far, there's no confirmation buyers are in the market just yet. If the market ever come lower into this bracket of prices, especially below this low, okay, then there could be the possibility of something in the higher time frame. Because prices do not normally go into a very deep retracement in the higher time frame, but if it does, then that could actually be worth taking a look. Okay, so far this three-wave pullback has already hit equality. No definitive evidence that the buyers are in just yet. Okay, there are some buying going on, okay, but no strong case of very strong buying interest just yet, at least not in the weekly time frame. Now let's say we go down to one time frame lower, we still don't see very strong evidence of buying interest coming in. We have a bounce here, which is three-wave, which is not ideal. We want to see a very sustained move, ideally in a five-way structure, especially with one that which is very impulsive. That will be evident of very strong buying interest. Right now, there is no sign of that. So maybe this is a pair that is worth keeping an eye on. Instead of looking at Aussie, maybe the better chase will be with the Kiwi dollars, because on the monthly time frame, prices are getting very, very close to the very deep retracement level, suggesting that we are trading with the trend because the trend is bullish. And if the trend is bullish, ideally we want to be on the long side rather than on the short side of the market. Okay, so okay, if I had to choose between Aussie and Kiwi, it looks like Kiwi may be a better choice, although it's a little bit premature to get in right now. We want to wait for further evidence that buyers are in. Okay, I think some of you wanted to see Sing dollars, but it's not an ideal currency pair to trade. So I have not updated my chart. Okay, let me see. I have not updated my chart in such a way that, okay, by and large, you can see that the dollar is weak relative to the Sing dollars. The US dollar is weak relative to the Sing dollars. Here we can see evident here the last three high has been going lower. That means the dollar is coming down relative to the Sing dollars, or another way of saying is that Sing dollars is relatively strong. Okay, so we have a bit of a bounce going on in the dollar versus the Sing, and so far the market does looks like it's incomplete. We are having a pullback here from $1.46 against the dollar, which may actually see lower prices going forward. Okay, but by and large, you can see that the dollar is weak relative to the Sing dollars, leaving the Sing dollars with the potential to actually gain more ground against the dollar. That means to say that Sing dollars may have a potential to gain further against its counterpart in the region. Okay, so we cannot see too much into this because I don't use the dollar Sing pair analysis here to trade, but I want to see this overall impact. Okay, the highs are getting lower. So far, we have higher lows, so it suggests that there is a counter trend currently in play. Okay, so this bounce from $1.27 is potentially part of a corrective rebound. Prices may eventually drift a bit lower and then finally find some kind of support before it goes back up again against the grain of move above 137. Eventually, it will come back down. And the $1.27, I think there's a very good possibility over time, not immediately over time, this low will be taken out. Okay, so I'm long-term bearish on the dollar versus the Sing, meaning say I will keep a good portion of my currency exposure in Sing dollars rather than convert it to another currency. Okay, so I think from this is all that I can tell you because I don't trade actively the dollar Sing, but it's a great currency pair to actually see how the dollar is trading relative to its other trading partners. Okay, what other thing you want to talk about? I have finished currencies, or unless you want me to talk about further currency pairs. If there's none, let's go to gold. Gold, like I say, is very exciting now because gold is at all-time high, but I do have a contrarian opinion about gold. Okay, gold on the higher time frame, needless to say, is on a tear. This is the monthly time frame of the spot gold prices. Now remember, the spot gold prices is quoted at a discount relative to the COMEX gold futures in New York. So here, the price here is not the highest you can ever get for gold. It's a lot higher in the futures contract. So here we can see that the gold, if you look at it purely from the technical perspective, appears to be on a tear. The highest traded so far is $3,057.44 per ounce. This suggests that this is a major bull market. The major bull market has been in place since when? I think it has been in place for quite some time, since the 1916. Okay, so it has been around for quite some time. Oh, 2016, sorry. So in the weekly time frame, we're likely to see continuation of that. Okay, again, this week itself, we see all-time high traded $3,057.44. No sign that the market is picking just yet, but be very careful. We are moving into the last week of trading for March. We're right now on the 23rd of March. We only have slightly over a calendar week before the month end. And I think every time there is a change of period, whether it's a change of a week or a change of a month, okay, then those are potential area in deadline in which we could see a total reversal. Okay, so here we are seeing that the price has been very, very strong. So near term, there's possibility we'll see further gains in gold, but I believe that we have only one more week before the March ends. This coming week is going to be crucial. I am of the opinion that either a high is in place or a high will be in place in the coming week. Okay, this $3,057.44 in the spot gold could represent the temporary high. Okay, that means to say that if this is correct, or even if we do have a marginal high higher than $3,057.44, I want to see how it closes towards the month end. If it close weak, that is the evidence that I'm looking for, that we could potentially be looking at a temporary high in gold. And if you have not already bought gold, don't buy gold at this current point in time. Okay, we could possibly see a corrective pullback. So this is, I think I've shown you the weekly, right? Yeah, this is the weekly. I want to show you the daily. So this is daily. Okay, no evidence yet that we are seeing a reversal, not clean-cut reversal. Okay, but I'm on the lookout for one. Like I say, either the high is already in place at on Thursday, or we could see a marginal high beyond 3,057. Again, the key here is to watch how it closes for the week and how it closes for the month of March. Okay, if it close weak, then I have the evidence that I need to tell me that potentially we are seeing a temporary high in gold. And what follows after that is potentially a period in which there will be profit taking and prices may actually suffer some kind of decline. Okay, so this is my take as to why that is the case. The reason may not be evident immediately, but I'm sure over time, some analysts will be able to find the reason why the market goes into a corrective decline. Okay, so far, if this is the case, this is only the first leg, but potentially if the market do take out $3,047.45, then temporarily we may go for another high. Okay, but I suspect the high could already be in place, or it will most likely be in place sometime in the coming week. So look out for that. And if you do see a reversal signal in the lower time frame, I may want to take a very aggressive posture by going against this rally here. Okay, purely for the idea that the high is already in place and what may follow could be a corrective decline. So this is my take. Okay, you don't have to do what I say, but observe the potential for that. Any other things that you want to see beside gold? I have no idea until the high is in place. Until I see evidence that the high is in place, would I be able to at least make a guesstimate as to where the market may head to in terms of a corrective pullback? Right now, I have no idea. Okay, I have to let the market tell me what it wants to do. So I have to determine that the high is in place first. And that can only be seen after the market hit a high with a negative reaction. And then evident in the sense that I do get a reversal pattern to the downside, and I will trade accordingly, going for that corrective decline. Okay, long term, the goal is in a bull market. So if you are going to be holding gold over the longer period of time, this is a bull market. What I'm saying here, for those who have not already bought, okay, the market may eventually give us a chance to buy a much more affordable level, not above $3,000. That's for sure. Okay, silver and crude oil. Okay, let's take a look at silver. Now, silver has been lagging behind gold all this while, okay? And maybe it's time to take a look at silver. Now, silver is in a long-term bear market. Unfortunately, it has not taken an all-time high just yet, okay? The high that we have seen so far is $49.51. That was in all the way back in 2011. Okay, for more than 10 years, we have no higher prices than $49.50. Yes, the market has bounced, but unfortunately, this bounce is in the form of a three wave, not as aggressive looking like a runaway freight train like gold. Okay, here we have a very corrective looking bounce in the higher time frame, which is the monthly time frame. Okay, so near term, as gold hit an air pocket, if it does come into a corrective decline, then maybe the attention will be shifted to silver. Right now, so far, technically speaking, this rally that we see in silver is not particularly strong. Okay, so if it go higher, let's see whether it will hit a serious air pocket anywhere between $38.60 to $44.20. Okay, it's struggling. Okay, so it's not in that very explosive phase, at least not evident in the monthly time frame. In the weekly time frame, you can see the market now is struggling, okay, near the $34 level. For the first time this month, we have a lower closing on a weekly basis. This week closing on Friday resulted in a lower close compared to the week before. Yes, we have a marginal high compared to the week before, but it did pull back 50% of its entire rally for the 2 weeks ago. Okay, so possibly we'll see a pullback as deep as $26.65. So let's see if the market does this in a pullback. Okay, and if you have to choose to buy silver and gold, maybe the pullback here, if it does pull back all the way to $26.65 to $28 and let's say 10 cents, we have a swing low here. Okay, this swing low here is at $26.40, very similar to this level here. So I will take my chance. Of course, I will look for buying interest. I will look for buying signal on the lower time frame, ideally in the 4 hours or in the daily time frame if it does. Here we can see that the daily time frame is beginning to see a bit of a pullback. Okay, all the way during this rally here, we can see that the market is actually struggling. It is not explosive like what we saw in the gold market. Okay, so be aware that silver has already topped out and is getting ready to pull gold along the way down. Okay, so again, watch out for potential corrective decline in the precious metals. In oil market, it does looks like oil has caught a bit of a wind. Okay, we can see oil market stabilizing below, let's say, $67 per barrel. Okay, the low so far is about $64 to $64.75. Okay, so anyway, on the monthly time frame, this is WTI. The market has actually stabilized around here. Note that I actually put a remark here. So I will be actively looking for a explosive rally in oil market because here there's a directional change. And it is accompanied by a potential panic cycle, meaning to say that any kind of bounce in oil could be very explosive. So of all the markets that I've shared with you so far, including equity markets and the currencies, I think potentially a big move for April may come from oil market. So I'm going to stay watching this like a hawk because prices in the monthly time frame has shown me that this price anywhere between $72 to $57 is actually very, very advantageous because the long-term outlook for oil is actually very bullish. Prices has actually been stabilizing at the mid $65 per barrel. Currently it's about $68. So we have not seen newer lows, although this month itself we saw an attempt to try to take out the $64.75. So far, it has met with buying interest. On the lower time frame, such as the weekly, for example, where's my weekly? The weekly here has no evidence of a strong reversal just yet. Although we did see one here at $64.75. This one bar here that you see here, okay, could potentially still be playing out. This is a reversal pattern, a single bar pattern, okay, and subsequent pullback here has not been able to go below here. So you see that I've actually preempt this market by doing this potential three wave. At the bare minimum, if it's not for a full resumption of this long-term bullish outlook, there will be a possibility of the market going higher than 93 cents, 93.96 cents, almost 94 cents. So right now we are in somewhere below $70 per barrel. For the market to go $20 per barrel, I think over time we can see a price beyond $93.96, potentially to $94.60 to $101. Okay, will it come? I have no idea, but currently where the price is, it does looks to be very attractive for those who are going to be able to hold the trade. Okay, you know that I don't do a lot of short-term trading anymore. But if the market does show me evidence of a buying interest coming in, I will definitely be very, very receptive to going in to buy. Okay, this Friday close not very strong, but Thursday was strong. Okay, so far again this is still very tentative. We have a potential bottom around $65 per barrel, but not constructive yet. Okay, I need stronger move than this. Can we see in the lower time frame like the H4, for example? No evidence. It is still struggling. Okay, so again, this is the longer it struggle and fail and pull back again, I will look for some kind of evidence of buying interest as it pull back. Like I said, we are coming towards the end of March. April, I do expect something explosive to happen in the energy markets relating to crude oil. So if it doesn't happen to have a bottom in March, I will be looking for evidence of a bottom in April. Okay, regardless, I think April I should be on the lookout for opportunity on the buy side for an explosive move to the upside, potentially beyond $93 per barrel to as high as $101 over time. Okay, what else you want to see? We're coming towards the end of my session. What is a panic cycle? Panic cycle is when everybody is trying to get in or try to get. Now imagine you are in the cinema and you know when the light goes off and the movie is in play, you can always see the exit sign. Now imagine there's only one exit and everybody for some reason needs to get out. That will cause a stampede at the exit. That is a situation like a panic. Now the whole world right now is short crude oil. thinking that a peace plan will be in place between Ukraine and Russia, for example. And if the exact opposite happen, for example, the war escalate beyond Ukraine, that will cause likely to be a scenario in which there will be panic buying of crude oil. After all, Russia is a major oil exporter. If something spread into Russia territory and hit their, let's say, their storage facility, for example, that will be classified as a scenario for a panic buying. Okay, I'm not saying that that will happen. I'm just saying that in a scenario such as that, that could be one possible scenario that will cause panic buying or at least panic short covering of short positions. Okay. Raja Kumar is asking, when is the demand for crude oil really? When? Crude oil is I would say, something that you need for production. Any kind of production, you need energy sources. And currently, as much as we are trying to pivot away into green energy, fossil fuel is in the near term highly unlikely to be replaced. So any kind of situation or event that will cause the supply of crude oil to be restricted will be considered to be high demand. Right now, there's no demand because globally, we look at China. China is buying less oil because their economy is struggling, and with Trump's tariff policy, it's very likely to cause a global recession. And if that case, demand for crude oil will go down because there will be no need to produce anything because demand is not there. But if that is a contrast with a deterioration in the geopolitics, that could be a game changer. Okay, don't just look at the market from the economic perspective. Sometimes something as serious as a widening of a war, either in the Middle East or whether in Russia, for example, that will be enough. That will be enough to cause a major panic buying. Now, let's say, for example, Canada retaliate against America for its trade policy and decided that they want to tariff America on crude oil. That will also cause a sudden shortfall in the availability of crude oil. Now, America buys a lot of crude oil from Canada. Okay, what the US produce on its own, those are the light crude, like the WTI, those they export. But why does a major oil producer like America import oils from Canada? Because the grade of the oil is different. The majority of all the oil refineries in America can only process heavy crude, which is something that the Canadian provide as well as the Venezuelan provide America. So those crude oil from Canada, for example, heavy crude, and the refinery can only refine those oil. The current refineries in the States, there is hardly any building of new refineries to process America's light sweet crude oil. Those, they find more advantageous to simply export them elsewhere. Okay, so they do depend on oil imports from Venezuela, from Canada. And if Canada wants to hit America where it hurts, for example, let's say if they impose a massive tariff for all the oil that they sell into America, that could be also one scenario in which they will cause panic buying of oil by the Americans. Okay, so this is just potential evidence. Okay, now let's talk about Bitcoin. Okay, Bitcoin has not been doing a lot of late. Okay, Bitcoin. Over the monthly time frame, okay, market went up a high of $109,567 on the IronFX platform. Okay, I was actually looking at 125,000. It did not come. The market has not been able to go much higher. I was looking for a pullback into March, which has actually happened. The pullback happened in February, which resulted in a marginal low in March so far at 76,600. So as far as this is concerned, I was looking for a pullback, which actually happens. Now, what happened is that this pullback will eventually see the resumption of the bull market. Okay, so overall on the monthly time frame, this market is actually very, very bullish. Okay, for the market to pull back 10% is very normal for Bitcoin. So here, what we want to do is do not want to miss out on the next potential explosive rally. So far, the pullback has resulted in a three-wave move, which actually hit equality at 123.6%, which is $76, 76,745. The low is 76,596. Good enough. So potentially what we are seeing here is that this pullback from the all-time high of 109,000 below 600, for example, has actually hit a bottom. Now, the overall trend is still very bullish. We have a three-wave equality pullback followed by a somewhat bullish reversal pattern for the month for the week before. So potentially there is the possibility of a near-term bottom, and the market could be getting ready to resume its bull run. And what could be the catalyst? We have a lot of talks and updates on America's trying to come up with some kind of legislature to actually build a Bitcoin reserve. And not only Bitcoin, I think they are also thinking about putting some of the altcoins into this basket, whereby they will use it to stabilize either the dollar or to find some ways to mitigate against a runaway US national debt. Okay, so again, we will have to see, but I think the condition is about right. Anytime now, we possibly may see sustained rally. So far, the bounce has been very corrective. You can see on the daily time frame, the bounce here has been very corrective. Okay, would it result in another leg lower? I won't say no, because so far we have this three-way pullback. Equality is anywhere between 80,000 to 84,000. Market went down to a lower of just below 77,000 and bounce. Okay, it can still go both ways, but over the long term, I want to look for evidence of some kind of buying interest. I am definitely interested to get back in. In fact, I have already gone long on Solana. It's not the best substitute for it, but I saw the signal in Solana, so I went into Solana because I didn't see the same thing happening in Bitcoin. So I already have some kind of exposure. Now, Solana is not the best blockchain, but it is a blockchain for a lot of meme coin. Okay, so let's see what happens. Okay, if the other altcoins also show signs of buying interest, that could be the that could be the one. So far, it is very corrective. Okay, no evidence that a major buyer is in just yet. But look out for it, because I think it's inevitable that the high at 109,600 may eventually be exceeded. Who else want to see something else? Doesn't the war requires crude oil? Yes, the world requires crude oil for normal economic development. But if there's a war, all this economic activity will have to take a back state. Okay? Demand for oil always comes from global economic growth. If the world is not growing, there will be less demand for crude oil, especially for China that imports practically all oils. And if China do not receive substantial orders, there's no incentive to go into production. So, but that could change if the supply of oil suddenly is become restricted, for example. Okay, then there will be panic buying to stockpile oil as a strategic asset. Okay, now imagine if the Suez Canal is closed, China can no longer get access to affordable oil. The oil market will immediately price oil higher. Okay, so that is possibly another example. Okay, right. Oh, Tanvi want to know Ethereum, XRP, and Cardano. Okay, let's take a look at Ethereum. So this is Ethereum. Again, let's take a look at the monthly time frame. You see a bit of a pullback. This pullback in the monthly time frame does not appear, unfortunately, to be over. Now, Ethereum has been lagging behind Bitcoin. You can see the high traded was $4,860.25, and that was way back in 2021. So the high that we saw, 109,600 in Bitcoin, did not play out in Ethereum. Okay, so in fact, we do have a bit of a pullback. So this suggests that maybe overall, the digital asset may still go into a period of either sideways or a decline. Okay, but that does not change the overall long-term view. Ethereum is long-term bullish. Okay, so right now it does suffer from a little bit of lack of interest. Okay, and if it drifts lower, anywhere on a higher time frame between $1,000 to as low as $86, that would be a great price if you ever get there. Okay, so again, Ethereum has a much better use case perspective compared to Bitcoin. Okay, so not sure whether it will drift back to $1,000. If it does, worth a look, because this is a three-wave pullback. On the weekly time frame, you see that the market here is doing this, right? Okay, we have a marginal high. This is what I call a bear trap. You know, this high is marginally higher than this one. Market trigger the buy stop here and then pull back down. Okay, this is maybe something potentially what we are seeing in the DEX. Remember the DEX chart, we have a marginal high followed by a pullback. So if it results in a sharper pullback, then all those people who have gone long at the break of a new high now will be looking like an idiot. Okay, so now as far as Ethereum is concerned, on the weekly time frame, prices are getting very, very close to the what you call very deep retracement area, anywhere between $1,700 to $1,070. I don't think it will go back to $86. Okay, but in the weekly time frame, it does looks to be a little bit more realistic for the prices to drop into the bracket between $1,071 or $1,700. I think that would be a much more realistic scenario. Okay, do look out for that. In the meantime, do not sell Ethereum because this is a bull market. Okay, right. Then I want to take a look at Ripple. Okay, now Ripple has not been able to benefit from rumors or news that the SEC is going to drop their suit against them. Okay, now for too long, the SEC, which is the U.S. Security Commission, has actually targeted Ripple, accusing them of offering a security without a security license. And Ripple on their end say that, you know, they have always viewed their coin as a commodity and not a security. Okay, things are changing because the current Trump administration has a lot of crypto-friendly people around him, and definitely things are changing at the SEC level, and definitely they will do something about reclassifying Ripple. Okay, so that actually is very positive. You can see that the price structure is very different in the Ripple market. The high trader is $3.40, and that was only quite recent in January. And prices have since pulled back, but this pullback, sharp as it was, managed to hold out at just under $2. So $2 appears to be the magical support here. Prices so far has been moving between $2 to $3. So the lower you get, the better it is. Now we cannot see any kind of meaningful pattern in the monthly time frame. For that, hopefully we can do. We can see something in the lower time frame. This is the weekly time frame. You can see that weekly time frame, potentially this is a tree. Okay, so if this is a tree, possibly we are seeing lower prices ahead. Not so evident in the weekly time frame, maybe in the next lower time frame, which is let's say the daily time frame. Okay, so if this is a three wave, the target could be $1.35 to as low as 97 cents. Okay, so we have a bit of potential three-wave pullback, but not very clear cut. But as we go down to the lower time frame, hopefully that become clearer. Okay, here we have this move here. Okay, this is very interesting. Okay, in a three-wave rally, the market hit equality just above $3.40. High traded $3.40, and market go into a corrective pattern. Okay, so if I have to do this, if this result in a move like this, the market go to $1.40, I will be a buyer. Okay, because I have always talked about wanting to buy at or below $2. Both time when it came, I didn't get in. Okay, and the next time if it does get in a pattern that looks like this, in a three-wave pullback equality, is definitely within this blue area. Means to say about $1 to $1.40. That will be a much more competitive level to get in on Ethereum, on Ripple, because Ripple does have use case. I mentioned previously that all Japanese banks use Ripple blockchain for payment, okay, for trade settlement. Okay, so this is a coin that has actually use cases, and Ripple is very likely to be part of this strategic reserve that the US is talking about. So that will be another buying factor here. Okay, so this is the overall outlook. If I have to buy any kind of tokens, it does that Ripple looks be the best case if the price can get into this bracket of prices, 140 to $1. Now, the other one that you want to see was Cardano, right? Okay, Cardano is ADA. It does not have a lot of history, but it is a bear market. The market since launch has gone into a bear market. Okay, and this has resulted in a three-wave move, not very clear in the monthly time frame. And this is a more recent product which does not have the benefit of longer historical data for us to see. Okay, but we can see price has gone up. It is the bear market. The overall market is bearish. Okay, so we have a bit of a bounce here, and this bounce so far is three-wave, and the pullback is also three-wave, resulting in one test just marginally above the very deep retracement level at 90 cents, 49 cents. The low here is 50 cents. Now, I would not want to consider this coin because the structure is not very constructive. If I'm overall bullish on digital assets, then this market here in Cardano long-term does looks to be a downtrend. So I am not going to consider, or rather I will not actively consider Cardano as a asset that I will be very interested to hold. Okay. I can't see anything beyond the daily. I think the daily is a bit of a quite messy. Okay, prices are stabilizing. It may have potential to go up, but it is locked within the bear market. I don't like it. Okay, so this is my take for these various digital assets. Raja Kumar is asking, is there a possibility to schedule this meeting a bit later at 10? No, I have to sleep. I understand the timing is not always ideal. So unfortunately, I cannot do at 10 o'clock. Okay, guys, if there's no further questions, that will be it. And next week, I'll go back to do the normal, which I will do the various data. But now I'm thinking about this. Going into today's presentation, I was thinking maybe this new format, I want to keep for a while and see whether it works for all of you and works for me. Because no point me showing you everything I want to show you where your interest is not there. I'd rather you tell me what you want me to cover, then I will respond to that. I think that will be more productive. Okay, thank you very much, guys, and I'll see you next week. Bye-bye. Take care.